Good afternoon, everybody. Welcome back to Markets for Millennials for this quick weekly update from the week of February the 14th to the 18th. And I'm calling this video essentially Danger Zone. And the reason why is because if you look across particularly the equity markets, we are seeing across the board, basically we've seen a rejection of key levels or continuations down, and it seems like the markets truly are rolling over now. Last week, I obviously spent a lot of time early on talking about the macro backdrop, geopolitical situation, and basically this week we had a series of, if I zoom in a little bit, so that we can go day by day, we had a series of kind of back and forth news events taking place. We had over the weekend, it seemed like things were subsiding a bit. And then early on Monday and Tuesday, it seemed like we kind of got a, never mind on, it looks like Russia's pulling back from Ukraine. And then just these last 2 days, we've just gotten a lot of fear. Once again, the market's spooked at Russian activity. And so it seems that in the midst of all of the things that are going on in the world relating to COVID, with what's going on in Canada, a lot of uncertainty in a lot of other areas, and what is taking stage more and more is no longer, as far as the financial markets are concerned, no longer more and more the rate hikes that people or that are being priced in, but particularly the geopolitical mess that is happening around the world, particularly with Russia and Ukraine. So if we just start off here, the S&P futures are looking to cross the 50 and 100-day moving averages. Right now we're just looking at the at the moving averages, and I'll kind of go back and forth between those and my art, my little drawings. And basically what we've seen here, and just to recap, just to go back, I have talked about this on a number of videos before, that when we had the March 2020 crisis going from February into March of 2020, we dropped below our significant moving averages, came up for somewhat of a retest, and then got rejected before heading down below. And you actually see that in a bunch of other places too. So going back into our kind of Christmas massacre, late Q4 2018, we had a drop below and then a rejection, not once, not twice, but 3 times off the 100-day moving average before eventually coming down below. And that, from the top to the bottom was over 20%. And so you can actually go back and find other occasions. Obviously, we had another similar kind of a situation which took place in 2015 and in 2016. That was a little bit different. This kind of reminds me a lot of what was going on with the Dow, or what is currently going on with the Dow and Russell. We'll talk about that in a second. But suffice to say, I've been saying this whole time, it's uncertain what the markets are going to do. You never know if the markets are going to just pick back up, because if you just pull back, let's just do a weekly chart here for a second and log scale this. What direction do markets generally go? Even through the dot-com bubble and then the great financial crisis, the markets go from the bottom left to the top right. So having said that, in the long run, wherever you buy, it's more than likely that 10 years later you're going to be higher than where you bought it. But obviously the markets have been under a lot of pressure. And you just have to be really careful here that you don't just buy unless you have a technical reason to do so. And so we have not really had a good successful retest above any of the major moving averages. We attempted here on the 200-day. We kind of bounced off of it, but failed to sustain that momentum above. And again, the moving averages are turning downwards. We also have not crossed above this trend line, which is kind of our first line of repair. And so things do not look good. Again, this is why, and I talked about it last week, this is why if you are buying or taking trades, you have to set responsible stop losses where you know you're wrong. And so right now, again, there's various levels. Like we have the closing low, which we kind of bounced off of today. We have the lowest red wick and then the lowest wick in general. And those areas are areas that I'm watching moving forward. Just for the sake of, I want to see if we're going to get follow through on the move to the downside. That's what I'll be watching for next week. On the Nasdaq, the retest or the testing has been, unlike the S&P where we've gotten over back over the 200-day and was testing the 100-day, we've never really gotten through and closed through the 200-day. We've kind of bounced off of it twice, and we're actually really close to getting a true resumption down, much closer than on the S&P 500. And we've already gotten our 50-day crossing the 100-day, and both the 50 and 100-day moving averages on the Nasdaq are now angled downwards. And so it looks like we're not too far away, maybe as early as next week, a week from today, or within the next 2 weeks of getting across of the 50 and the 200-day, and that's going to be it's going to be a sign that the long-term momentum is more down, and so really concerning. The Dow, from a technical standpoint, we're actually closing lower than we've closed since December 1st, and we're making lower closing lows than what this recent bottom was here. And you have to remember that during this week at the end of January, we had an FOMC meeting, and so there was a lot of price volatility. That's why you have these really long, they look like liquidation wicks, but both to the upside and to the downside. So you get a lot of those right there, but then you don't see those same kinds of wicks since then. And we actually, unlike the S&P and Nasdaq, we got above all of the moving averages. But the thing about that is that for some time, these moving averages have been getting more and more squeezed together. So we did come up. You obviously saw when I updated my descending trend line. In this case, the moving averages are much more squeezed together, and that's why I've said a lot of times when you get those moving averages squeezed together, you're going to get a pretty decisive move either to the downside or to the upside. And right now, just given the geopolitical situation, it looks like we're getting that move to the downside. And so things are looking very precarious. And then the Russell obviously closing below a horizontal level. And it's, we've had all the crosses. We've had the 50 moving average close below the 200 and the 100-day close below the 2 average, and they're all pointing down. And I've said, I basically said for all of 2021, the Russell is a much better indicator of the actual economy. And so it looks like after all of this, that the other markets are deciding that they want to come back rather than move up. And, geopolitical situations like what we're going through right now can do that. And so it's something to be aware of. Another thing that I just wanted to mention, just in general to think about, is that the markets, if you go back in history, and I don't think these charts will be able to show me, but if you go back in history to any situation where there was war fears, we got the sell-off, but then the markets typically recovered fairly quickly after that. The market tends to look forward beyond those geopolitical conflicts faster. And so all of this has actually been really positive for gold. You can just kind of see, and again, for a while, I've been talking about this kind of rounding bottom in gold, saying that I think gold's time is coming. I think even as, towards the end of December and in early January, I was talking about this happening. Then we had that pullback at the end of January from the FOMC meeting. But we never really made true lower lows compared to these other moves. And all this geopolitical mess has been really solid for gold. And here we are closing this week at 1897, which is just amazing, again, to think about if we go back to where we were barely over 1800, at the beginning of February. One of my weekly update from February 4th, from that weekend, we had gold barely closing at 1807, and just in a few short weeks, in 2 weeks, we are almost $100 above on gold. That's really big moves for gold. And so as long as the geopolitical situation looks uncertain, gold is the safe haven that everybody rushes to. And silver has benefited from that, but silver is not making the higher highs like gold is. So if you actually look at this chart, we've got if we start over here from May 2021, lower high, you don't see that same thing, right? We actually are close to making a higher high from that period of time, from that first period of time. And as you can see, this chart is actually starting to curl up to the upside rather than what we see on silver, which is we've just seen, again, more of a constant downtrend. Although, if you actually look at this here, let me pull this up, see if I can do this. We're actually creating something like a triangle or a wedge or however you want to call it. And so silver also something to watch out for. When the metals are in a bull market, then obviously silver will outperform, except for in the case of geopolitical instability, in which case gold typically is going to be the leader there. And so actually I could go to my gold to silver ratio. We're still kind of chugging away more to the upside, so gold definitely advantageous there, but that's just something to think about. I don't usually look at the VIX, but you can obviously see that the VIX, after spending most of the time since that March crash of 2020 making lower highs, lower lows, lower highs, lower lows, we kind of bottomed out, and you can actually see that not only is our VIX curling, like the bottoms are curling, you're also seeing bigger shots to the upside. Okay, so the size of those moves to the upside are getting bigger, and so that's also the result of the geopolitical tensions that are taking place. Now, the interesting thing, a lot of people have been talking about this, so I won't belabor this. A lot of people have been talking about how, given all that's going on, the dollar is kind of staying in this range. We had a kind of a fake breakdown and then a fake breakout, all within the first 2 months of this year. And so that's something I'm definitely watching for. And so the dollar, typically, I'm kind of wondering, are we going to continue to protect this support? Are we going to get, are we going to get a dollar milkshake kind of a situation? Is there going to be a rush to the U.S. dollar because of what's happening in the equity markets and whatnot? And nobody really knows. Yields after in the last week, let's see. So yeah, that's right. So at the end of last week, we had a move finally above 2. It looked like we were getting a continuation, but now if you actually see yields closing below the 2% level, and I talked about this a lot. I said that, I even said this back here, that I thought that even if yields get up to 2%, they're going to have a hard time staying up there. Now, this is not to say that they won't go higher. I would say another key level is along this trend line, which right now is coming in along between 2.4 and 2.5%. So I'm going to be watching that because I think that's a really important long-term level. If you pull up actually a weekly chart and you just kind of look, you can kind of see it's not perfect, but you can kind of see some of the symmetry there, which is why I'm watching those levels. Yeah, and then Bitcoin just having a really hard time. Now, I actually, let me get rid of this for a second. I just want to walk you through my thought process. I had that blue line that I'm actually going to dim it a little bit more. I had that blue line dimmed. So when I first pulled up my chart today, actually, this is what I was looking at, because I basically, after we kind of had this wick on the 10th, I just prematurely moved this trend line, or I made a trend line from our November top, peak top, to February 10th, because I was thinking, well, are we going to get another situation like we had over here, where we had basically this trend line, and then we had this trend line. Are we going to have something similar? And so I just kind of did that prematurely, not knowing, and it looks like that level is holding. So that's actually not a good sign, and we made a lower low, obviously, from, it looked like we were going to come up, that we were going to come back up and break out once again, but we definitely got, risk assets in general got kicked in the pants here the last few days on all of this Russia news. And so I just want to show you too what these trend lines were. I basically made two trend lines, one that was connecting the two red wicks, which is much more shallow. We're closing below that, or actually we still have 21 minutes between right now at this moment and the close. So obviously closing below that is not really good. This other one, we've definitely already closed below it. It was just taking the two lowest wicks. And I was using that to see if there was if we were going to catch the support here at some point, because obviously you can't have, if you think about it, from our wick down here to this top wick, that was almost a 40% move in 17 days. That price movement is not sustainable. So you're going to get a pullback. And so I was basically using these trend lines to just ask the question, where are we going to get the pullback? Where are we going to find support? And it looks like as long as things continue, that none of these are going to find long-term support. I'm actually going to get rid of this one now. And actually, if I put that back up, it looks like we were about to come back up and then retest it, but it failed. So again, let me get rid of this steep one. Right, so then I was watching that, and then I realized that I had a faded line back here. So if I darken this back up, this line actually is from connecting our April 2021 high to what we were calling the wave 1 high in September of 2021. And we actually are kind of bouncing off that. Now, what I haven't done, and I'm going to do it right now, if I log scale that line, then obviously we are below, and so that does not look good from a log scale standpoint. So things are not looking good. Again, you can never foresee these things. I don't think anybody thought, like I just was, let me go find really quick. I didn't pull this up, otherwise, oh, my computer's taking forever. I was talking about this on Twitter with somebody recently, because back in November, I posted this saying, is Tesla about to have a blow off top? First chart is Tesla, second chart is both the Bitcoin blow off tops. Because at the time, if I just pull this up, this is what the Tesla chart looked like at the time. And it just was like booming. And little did any of us know, let me go find Tesla really quick. Little did any of us know what was going to transpire in the time since then. Obviously, the chart looks different now. Let me go to a line chart. So I took that screenshot when price was up here. And it was really interesting because we had this sell down and then a bounce. And this sell down had to do with Elon basically saying he was going to sell some of his Tesla stock so that he would pay taxes. And then we had this initial bounce up, and I was like, oh my gosh, this is starting to look like a blow off top. We were coming down, right? And then at the end of December, we had just this sell up, or this, this buying come up. And then ever since then, we've been back down. And it actually, Tesla is closing below a pretty important trend line that has been established ever since the March 2020 low. So it'll be interesting to see what happens there. But again, just kind of to what I was saying, because I was talking about what's going on in Bitcoin, who could have ever foreseen, back in November, because here's what Bitcoin, like at that time in Bitcoin, when I took that screenshot of Tesla, Bitcoin was up here and everything looked just dandy. And who would have thought that we would have had this gradual sell down across all markets, basically, since around that time. We had some sideways on the S&P and on the Nasdaq, and then have sold down. So again, who would have thought that we would have had that selling pressure from the potential for rate hikes and the inflation prints, and now here we are kind of compounding that with the geopolitical tensions that are taking place. So you can never see that stuff coming. And it seems like the only thing that has just continued its run has been crude oil, which if you go, again, from our wick low at the beginning of December, we're currently up almost 50%. So obviously energy is doing pretty well. Oil is doing pretty well since then. And I anticipate that oil will continue to move up because geopolitical tension will cause some scares in as it relates to energy and oil delivery, and so the value of oil will probably go up even as the tensions escalate between Russia and Ukraine and the involvement of the U.S. And all that stuff. So that's my look at the market. Again, danger zone. Be very careful here. Don't just trade, or be careful with your trading. Make sure you set your stop losses appropriately. And even let me just show you this to the upside. Your stop losses are there or there or there or there. This is the most conservative one up here. But you have to be really careful shorting because, again, to remind you, markets move from the bottom left to the top right. And so eventually, even if it takes a long time, eventually you will get stopped out if you're not careful. And so whenever you take short positions, you have to definitely not be married to those positions. Be willing to back out of them really quickly to the when they're to the short side. So that's my view of the market. Hope you enjoyed this video. Go ahead and like and subscribe and share if you thought this video was beneficial, and I will see you guys next week.